Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Sharon Patton, mortgage broker in Burlington, Ontario.
If you're sitting across from your spouse right now trying to figure out who keeps the house, and whether you can even afford to keep it on your income alone, this episode is going to answer the question nobody told you to ask before you signed anything.
That question being, what do I actually qualify for under the stress test on my own?
Exactly. And the reason that question matters so much is that the answer can completely change what you agree to in the separation agreement.
Sharon Patton works with clients in Burlington and across the Halton and Hamilton region on exactly this, divorce and separation mortgages. And she's clear that the stress test is the central obstacle in most of these files.
Let's set the scene. A homeowner in Burlington is going through a separation. They want to keep the family home. The equity is there. They assume the buyout is straightforward.
And then they find out that equity and qualification are two completely different things.
Right. Having equity in the property does not mean the lender will approve the mortgage. You still have to qualify for the new amount on your income alone, at a stress-tested rate.
And that stress-tested rate is higher than what you'll actually pay. OSFI sets the qualifying rate at the greater of your contract rate plus 2 percentage points, or a 5.25% floor.
So the bank is asking, can you carry this mortgage at a rate you're not even going to be charged? On one income?
For a lot of people coming out of a two-income household, that math doesn't work the way they expected.
And this is where the standard process fails separating borrowers, because most people approach this like a normal refinance, and it isn't one.
The documentation alone is different. Sharon Patton is clear about this. A separation file requires the separation agreement or draft agreement, any court orders related to support, and a full picture of how property is being divided.
And support payments, whether you're receiving them or paying them, affect your qualifying income in ways a standard file doesn't have to account for.
If you're receiving spousal or child support, that income can typically be included, but only if there's a signed agreement in place and a demonstrated payment history.
And if you're paying support, your qualifying income goes down because the lender treats it as a debt obligation.
So the separation agreement and the mortgage qualification are deeply connected, and most people don't realize that until they're already in the middle of finalizing terms.
Which is exactly why Sharon Patton's approach starts before the agreement is signed, not after.
That's the core of what she does differently. She runs the numbers first, what income can be included, whether support payments are documented, what the property will appraise at, so the client knows what they're actually working with.
Let's talk about the equity buyout specifically, because that's the most common path when one spouse wants to stay in the home.
The buyout works by refinancing the existing mortgage to pay out the departing spouse's share of the equity, remove them from title, and leave the remaining spouse as the sole owner with a new mortgage in their name.
And a formal appraisal is required, not an estimate, not a real estate agent's opinion of value. A lender-ordered appraisal.
The other thing Sharon Patton emphasizes is closing costs. Legal fees, title insurance, discharge fees on the existing mortgage. Those come out of the equity before the split.
So the gross equity number and the net equity number can be quite different, and agreeing to a split based on the gross number creates problems at closing.
There's also the penalty for breaking the existing mortgage early. Fixed-rate mortgages typically carry an interest rate differential penalty, which can be substantial depending on how much time is left on the term.
Sharon Patton can pull the exact penalty figure from the existing lender, so the real number is known before anything is finalized, not after.
That's the kind of detail that prevents a disagreement between two people who are already under enormous pressure.
Now here's something that surprises a lot of people. The existing mortgage doesn't automatically change when a separation happens.
Both spouses remain legally responsible for it until it's formally restructured or discharged. The lender is not a party to the separation agreement, so the separation agreement doesn't change the mortgage obligation.
If one spouse stops making payments, both credit profiles are affected. The lender doesn't care what the agreement says.
And the departing spouse, the one who moves out, remains on the mortgage until the remaining spouse completes a refinance that removes them, which requires the remaining spouse to qualify on their own.
So if the remaining spouse can't qualify, the departing spouse stays on the mortgage, which affects their ability to qualify for a new mortgage of their own.
That's a real bind. And it's one of the most misunderstood parts of how divorce and separation mortgages actually work.
So what happens when the remaining spouse can't qualify through a traditional lender? Is homeownership off the table?
Not necessarily. And this is where Sharon Patton's work in Burlington gets into territory that a lot of borrowers don't know exists.
Alternative lenders.
There are approximately 300 active alternative lenders in Canada, responsible for between $13 and $14 billion in outstanding mortgages. That's not a niche corner of the market, it's a substantial and regulated part of the lending landscape.
And the key difference for a separation file is that alternative lenders don't apply the federal stress test in the same way that federally regulated lenders do.
So a borrower who can't qualify for the buyout amount through a bank may qualify through an alternative lender, often as a bridge solution while they stabilize their financial picture post-separation.
The rates are higher and the terms are shorter, but the access to equity is real.
Alternative lenders are also more flexible with income documentation, which matters if a borrower is self-employed, recently changed jobs, or is in the early months of receiving support payments.
Sharon Patton is direct about this. Using an alternative lender is not a sign of financial failure. It's a bridge with a plan.
The plan matters as much as the approval. The goal is to refinance back to a traditional lender once the income is established and the credit profile is stable.
Let's talk about the separation agreement itself, because the timing of that document has a direct impact on the mortgage timeline.
Sharon Patton is clear. The agreement doesn't need to be fully executed before a pre-qualification can happen, but it does need to be in place before a lender will issue a formal commitment.
And the mistake people make is treating these as sequential. Finish the legal process, then start the mortgage conversation.
That adds weeks to the timeline and creates pressure at exactly the wrong moment. The mortgage broker and the family law lawyer need to be working in parallel.
Separation agreements often include deadlines for one spouse to complete a buyout or vacate the property. Missing a mortgage deadline in that context has legal and financial consequences.
A broker who works regularly in divorce and separation mortgages understands how those legal timelines interact with lender processing windows, and sequences the file accordingly.
Now let's bring this back to the question of whether someone can actually come out of a separation as a homeowner. Because Sharon Patton's position on this is worth stating plainly.
It's realistic in more situations than people expect, provided the numbers are run early rather than assumed.
The equity from the family home can serve as a down payment on a new purchase. Support payments, once documented, can improve the qualifying position. The picture is often better than the initial assumption.
But the only way to know is to run your own numbers, your income, your equity split, your stress test qualification, before the agreement is signed.
And that's the work Sharon Patton does for clients across Burlington, Oakville, Hamilton, and the surrounding Halton and Hamilton region.
She maps out what the mortgage options actually look like before any agreement is finalized, so the client is making decisions based on real numbers, not assumptions.
Let's close with the outcome, because that's what this is really about.
A client who comes to Sharon Patton before signing anything leaves that conversation knowing exactly what they qualify for, what the equity actually produces after costs, and whether a traditional or alternative lender is the right fit.
The separation agreement gets drafted around real mortgage numbers. The buyout closes on time. The departing spouse gets removed from title. The remaining spouse owns the home.
Or both spouses move into separate homes with down payments they understood before they agreed to the split.
The lesson here is simple. The mortgage conversation has to happen before the legal agreement is finalized, not after. The numbers inform the agreement, not the other way around.
If you're in Burlington or the surrounding area and you're navigating a separation, Sharon Patton at Mortgage Architects is the right starting point for that conversation.
Sharon Patton is a mortgage broker in Burlington specializing in divorce and separation mortgages.